In a fast-paced business environment, staying ahead of the curve is often presented as the key to survival. From artificial intelligence to shifting demographics, new industry trends emerge constantly, promising to reshape how we work and live. If you are an entrepreneur, an investor, or a professional, you have likely wondered how much time you should spend tracking these developments. Spending too much time chasing every new trend can distract you from your core operations, while ignoring them completely can leave you obsolete. In this video, we will explore the economics of trend analysis. We will break down how trends serve as early signals for market shifts, how to distinguish between short-term fads and long-term structural changes, and how to integrate trend tracking into your business strategy without losing focus. To decide if trend tracking is worth your time, you must understand how trends act as early indicators of market shifts. Economic landscapes are constantly reshaped by three primary forces: technological innovation, regulatory changes, and shifting consumer demographics. When these forces interact, they create new market opportunities and render existing business models obsolete. For instance, the rise of remote work was accelerated by technology, but it quickly influenced commercial real estate demand, corporate software spending, and local retail sales. By tracking these trends early, you can anticipate shifts in demand and position your career or business to benefit from the transition. Furthermore, understanding trends provides a first-mover advantage. Companies that identify structural shifts before they are widely recognized can secure valuable resources, establish brand authority, and capture market share at lower costs. For example, early adopters of cloud storage or mobile optimization built significant technical advantages over competitors who waited until these practices became industry standards. Trend tracking helps you identify these strategic pivot points, allowing you to allocate capital and development resources before market entry becomes crowded and expensive. As a result of this proactive analysis, you can build organizational resilience. Rather than reacting to market shocks after they occur, you can anticipate regulatory adjustments or changing customer preferences. This foresight allows you to transition your offerings gradually, reducing the operational friction and financial strain of sudden pivots. By viewing trends as leading indicators of economic change, you transform trend tracking from a passive, recreational activity into a core component of your strategic planning process. While tracking trends offers significant value, the primary challenge lies in separating genuine structural shifts from temporary fads and marketing hype cycles. In the digital age, information spreads rapidly, creating feedback loops that inflate expectations for new technologies or business models. This process is illustrated by the Gartner hype cycle, which shows that new innovations often experience a peak of inflated expectations driven by media attention, followed by a trough of disillusionment when the technology fails to deliver immediate results. Investors and businesses that allocate significant capital at the peak of this cycle often face substantial financial losses. Differentiating between a fad and a trend requires analyzing the underlying unit economics and consumer utility. A fad typically relies on novelty, social contagion, or temporary regulatory loopholes, whereas a structural trend solves a fundamental problem more efficiently or at a lower cost than existing alternatives. If a new business model relies entirely on constant venture capital subsidies or customer excitement rather than sustainable margins, it is highly likely to be a temporary phenomenon rather than a permanent market shift. Furthermore, chasing every emerging trend creates significant operational drag. When a business constantly shifts its product roadmap, marketing message, and employee focus to align with the latest industry buzzwords, it dilutes its core expertise and confuses its customer base. This dilution can lead to wasted development resources, declining employee morale, and lost market share in the company's core business. Recognizing the high cost of false signals is essential to determining how much time to dedicate to trend tracking. Finally, integrating trend analysis into your career or business requires a balanced strategy that protects your core focus while remaining adaptable. A successful approach relies on the 70-20-10 resource allocation model. Under this framework, you dedicate 70% of your time and capital to your core, proven operations. You allocate 20% to adjacent opportunities that are closely related to your core strengths. The remaining 10% is set aside for speculative experimentation with emerging trends. This structure ensures that your business remains grounded in stable revenue while systematically testing new opportunities. This balanced approach also requires establishing specific triggers for action. Rather than pivoting your entire business model based on a news headline, you should define clear metrics that must be met before committing significant resources. These triggers might include customer requests, competitor movements, or specific technological milestones. By establishing these boundaries, you prevent emotional decision-making and ensure that your response to market trends is methodical and data-driven. For professionals looking to build this capability, a clear checklist can guide your routine. First, dedicate a specific block of time each week to industry research, rather than allowing constant news notifications to interrupt your daily work. Second, focus on macro indicators, such as demographic data and regulatory filings, which change slowly but have a high impact on market structure. Third, validate trend hypotheses by speaking directly with customers to understand if their buying habits are actually changing. Recognizing the difference between noise and signal allows you to leverage trends to build long-term value. Market Map Explained breaks down the forces behind industries, companies, prices, and economic shifts. We turn complicated market stories into clear visual explanations, showing how incentives, competition, regulation, and technology shape the world around you. This video is general business and economics education, not financial, investment, or legal advice. Economic models are simplified for illustration purposes.